If you think about the challenges that the global economy faces, a war in the Ukraine, a war in the Middle East, increasing economic nationalism around the globe, which normally makes all people poorer, greater taxation relative to GDP, greater debt relative to GDP, there's a lot of reasons why the global economy might curl up in the corner of the room in fetal condition and just sort of moan and wail. But the truth is that we struggle through. The U.S. economy, too. I need to say that the U.S. economy is an economy that increasingly works for people like me and not so much for other people. An economy that has been exposed to globalization so that people who don't have the skills to compete on a global level are seeing their real standards of living deteriorate. An economy, too, in the United States where artificially low interest rates penalize savers, reducing the amount of money that they get on their savings while subsidizing investors like myself, people who have access to credit and the education as to how to use it. So I understand that one of the problems with our economy, and in fact the global economy, is that a whole bunch of people aren't participating. That notwithstanding, a whole bunch of people, investors and people with access to credit, are. And I am still surprised by the relative strength. I do note that there are some warning signs in the economy, and those warning signs are more pronounced they were than the last time that you and I spoke. One example would be in the U.S., where the Fed has reduced the short-term interest rate, but the market hasn't listened. The yield on the long bond has gone up. I've seen this happen 4 times before in my career. These weren't the promises of good times ahead. This is the investor saying, irrespective of where the short-term rates are, inflation is rearing its ugly head. And the idea that I'm going to be contented with a 4% yield some years out, given the fact that the rate of deterioration of the purchasing power of the U.S. dollar is increasing, the probability of that is nil. That's not a good sign. When the Fed loses control of the long yield, when the market reasserts control of the long yield, that's often a harbinger of more challenging times to come. 2, when you look at the U.S. stock market, which if you only look at the indexes shows some signs of strength, that ignores breadth. Most of the breadth in the S&P 500 is comprised of 10 or 12 stocks, the sort of Nvidias of the world. And when you look at the breadth in the rest of the equities market, one becomes challenged. The flip side of that is that the equities market isn't as overpriced as one thinks it is. Value stocks, community bank stocks, small cap stocks, out of favor stocks are, if you use the metric earnings or cash flow relative to enterprise value, not as expensive as the S&P 500 looks. In that sense, maybe we will ultimately get broader breadth. Or if we have a circumstance where major equity markets decline, maybe you'll see a circumstance where the out of favor stocks in today's market decline by less than the glamour stocks going forward. Gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the U.S., and by default, the world's preeminent savings instrument is the U.S. 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the U.S. dollars is measured conventionally by something called the CPI. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the U.S. dollar. If you believe the CPI, it would suggest that the deterioration of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say, 2000 to 2025, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents? When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum. I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the U.S. 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%, which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5% in a currency that's depreciating by 7.5%, you're losing 3% a year. The concept of investing in a riskless asset, a U.S. 10-year Treasury, where your purchasing power declines by 3% a year compounded over 10 years, is not very attractive. And this is precisely the circumstance where gold does well, and gold has done well. The second part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't in fact been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the U.S. dollar and the weaponization of the SWIFT banking system, which is to say the U.S. government's attempt to use the U.S. dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in U.S. treasuries and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your U.S. treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the U.S. dollar challenged, often in favor of gold. One final piece of arithmetic, that is this: gold is really underowned historically. J.P. Morgan Chase suggests that the market share of precious metals and precious metals-related securities is less than 0.5% of total savings and investment assets in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by J.P. Morgan Chase to be 2%. So gold doesn't have to win the war against the U.S. dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen. I don't own gold because I think it might go from $2,700 to $3,000. I own gold because I'm afraid it's going to go to $9,000 or $10,000. Why do I say that? The last time that we had sustained deterioration in the purchasing power of the U.S. dollar was the decade of the 1970s. In that period, 1970 to 1980, according to the Office of Management and Budget, the U.S. dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, what was $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from, admittedly, a price-controlled $35 to $850. And I think passes prologue. I don't see any reason, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion, that is to say with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means much higher gold prices. I don't believe that Mr. Trump is serious about cutting spending. I think he's serious about rewarding people who give him power. As to the Department of Government Efficiency, I think that's the strangest form of fiction I've read in many years. The first instance, to appoint the person who heads it, somebody who has enjoyed literally billions of dollars of subsidies and transfer payments. I mean, Tesla wouldn't exist without subsidies, nor would SpaceX. So to appoint, admittedly, a very efficient hog seems suspect to me. There's a wonderful man named David Stockman. David was the director of the Office of Management and Budget in the Reagan years. And he wrote a wonderful book called The Triumph of Politics that all of your listeners should read. The Triumph of Politics describes how the Reagan Revolution, and by the way, he didn't squeak through like Trump did. Reagan had a broad mandate to make government smaller. And Congress derailed Reagan Revolution in 120 days. I think the chance that the Department of Government Efficiency has to rein in government spending, particularly government spending around entitlements, the $100 trillion problem, is nil. We absolutely, positively have to deal with it. Did you know that it is estimated that the increase in off-balance sheet obligations, entitlements, every year, the increase in the unfunded liabilities is $2.5 trillion, and the increase in on-balance sheet liabilities, which is to say the, quote, deficit, is about $2 trillion a year. So every year, this debt pile gets $4.5 trillion bigger. Meanwhile, gross federal revenues last year before spending, all the money the government took in was $4.5 trillion, which is to say the problem gets bigger every year by the total income of the U.S. government. I'd tell all the intended beneficiaries, too bad, so sad, money gone. I would probably change the defense budget to reflect the dictionary definition of defense, which is to say the protection of the domestic interest within our borders. I wouldn't have troops in 110 countries. You say to the $36 trillion in bondholders, sorry, we default. By the way, we're nuclear armed. Try to seize your collateral. We acknowledge that we can't meet the operating expenses of the U.S. government, never mind the entitlement expense. We have a depression, we have deflation, and we reset to the liquidation value of our assets. That seems highly unlikely to me. Americans are by nature positive people, and they would prefer to kick the can down the road rather than call the question. And I think that's what happens. I really think that the reset that we have is on the installment plan, like the decade of the 70s. We reduce our individual purchasing power very gradually over 10 years rather than all of a sudden. Some sectors are cheap. Oil and gas is cheap. It's priced like the big thinkers. Joe Biden and Angela Merkel were right. It's priced like the oil and gas business is going to go out of business in 2030. Except it's not. It's going to continue to 2065 or 2070. And I think a Trump presidency probably is good for the oil business in that some of the really idiotic de facto regulations of the Biden administration will have gone the way of the dodo. Wholesale property and casualty businesses are cheap. The industry is getting sold off very hard now as a consequence of the California fires. And I'm not so sure that I would want to be in the retail property and casualty business, which is to say I wouldn't want to be an auto insurer or even a home insurer. But commercial insurance and reinsurance is cheap. Small community banks are cheap. Banks with below $1 billion market capitalization appear to be very good value. The big property casualty insurers and the little ones are really good value. Some of the global miners are decent value. Take control of your future. Don't rely on society to do it for you, because the Commonwealth, frankly, is empty. As a saver, have gold for insurance purposes. Hope it doesn't go up, but be prepared if it does. If you're an investor, consider buying the best gold stocks. If you're a speculator, look at the penny dreadfuls. There's lots of money to be made there if you're willing to work and take the risk. Beyond that, invest in the biggest and best oil and gas companies, the great dividend payers. Warren Buffett is going to 30% on Occidental Petroleum. How many times has he been wrong? Not very many times in my life.